Welcome everyone to this week's episode of 22 Minutes in Lending. I'm your host, Vince Passione, and on today's episode, we welcome Matt Harris, partner at Bain Capital Ventures. Aside from his day job as a successful venture capital investor, Matt is also a frequent contributor to Forbes, and as well, he's also a fellow history enthusiast, I think military history, which we'll get some of those nuances as we get into the presentation. I've known Matt for a long time. I'm excited to hear what he has to say. Without further delay, let's start these 22 Minutes in Lending. So Matt, thanks for joining the podcast.
Oh, Vince, I'm really glad to be here. It's terrific to see you again.
Awesome. So look, I know I'm a little late, but congratulations on closing those two funds. I think it's almost $2 billion of funding that you closed in the first quarter.
That's right. Our latest series of funds spanning early stage venture capital through to late stage venture, around 1.9 billion, up from 1.2 in our prior set of funds.
Amazing. That's great. Great vote of confidence. So congrats. So look, let's jump right in. I was recently watching the Bain 2023 Fintech Summit. You had a wonderful presentation called The Fog of War. So hopefully you'll tell us the connotation of the fog of war. But one of the comments that you made was about the recent banking failures and reflecting on history. You said, look, these failures, they typically don't come in small numbers. They typically come in waves, and that perhaps we haven't seen the extent of this wave. So could you elaborate on that a little bit more and your thoughts about that?
Yeah, I think there is a kind of a near in issue as it relates to the three large bank failures that happened in the spring, which were taken together quite unprecedented in their size and intensity. And then since then, there have been crickets. And even just if you look at it has a certain set of failures, they're likely to have implications for other financial institutions. So that's why we don't generally have narrow, focused, temporally brief banking crises. We tend to have a kind of rolling thunder situation just when you look at history. And I will say in this case, the regulatory response and the coordination across government was very well done. And of course you'll have critics, but as somebody objective and neutral, I found it to be timely, thoughtful, not overly generous to anyone, certainly not the executives of the financial institutions involved. They really were looking to protect depositors, and in doing so, prevent more runs by depositors. So we had a great response, and there's a certain set of people who think, therefore, we're done. But the rapid increase in interest rates that turned the balance sheets upside down at Silicon Valley Bank and Signature, and at a bunch of other regional banks, whether they're held to account for it or not, is a pretty fundamental problem that I don't think will go away quickly. And so our best case scenario is that pain kind of leaks out over quarters, that we don't have a recession, that rates start to temper, that those assets that were impaired can in fact be held to maturity and realized at par. And so you've got an earnings problem that doesn't turn into a liquidity problem in the system overall. But the other concern is commercial real estate and other real estate assets. So not just the sort of flightiness on the liability side of the balance sheet, but and sort of the rate driven markdown of certain assets like mortgage securities and others. But this sort of fundament of bank balance sheets and credit union balance sheets, this commercial real estate, as well as multifamily now, looks increasingly scary. And so in 2023, we're sitting here, we're still worried about a recession. We don't actually know what direction rates are going in. We're concerned about the flightiness of depositors who've been spooked earlier this year. We know that the held to maturity books of most of these banks are impaired. And if they ever had to sell them, they'd destroy equity capital. And we are all, as a society, worried about the value of the real estate based on new working patterns. So I take that and I say, well, yeah, probably there's going to be more trouble to come. And that has kept me a little jittery even as the summer's worn on and nothing bad has happened since the spring.
No, it is interesting because when we look at these failures, right, and you go back over to understand what causes them, right, and it's usually three. As I was talking to some of the folks at the FDIC, and they said, well, it's either going to be around deposits, it's bad loans, right, or it's this imbalance between or inequity between loans that they can make and deposits that they take in, right, which is their spread. And the most recent was really around deposits, but they were peculiar deposits, right? These were very large, lumpy deposits. And I was fascinated, I don't know if you were, by the lack of understanding by so many very sophisticated people about FDIC insurance and then products like IntraFi, right? And their Cedars program and how you could protect these deposits, right? By moving them out to other banks, or you can take them and move them into other investments. Uh, but I found that to be very interesting. And also it seemed it's almost like an anomaly, right? Because they were very lumpy deposits as opposed to what we see in most banks. So for example, in the credit union space, our clients, almost 93 to 95% of those deposits are FDIC insured. Uh, so in some ways, I guess I looked at it and said, yeah, maybe the amplitude of this wave isn't going to be as great as what we saw perhaps in the Great Recession, where this was like I think it was like 570 institutions fail when I looked at that chart that you'd been presented.
Yeah, no, I think that that is a good argument that Silicon Valley Bank and Signature were both distinctive in that way, and credit unions are far at the other end of the spectrum. And if you, as you did, and I appreciate that, if you watch the video, it's actually less about Silicon Valley Bank and the depositor flight based on chunky uninsured deposits, because that was a really distinctive and anomalous phenomena within the sort of high tech bank community. But there's sort of a medium and longer term threat that I personally think if I were the CEO of a credit union, I'd be more concerned about. I think you can rest assured. Hopefully now everyone's using IntraFi, so hopefully people have solved their own uninsured deposits problem.
I think Mark Jacobson's really excited about that. And it's
I think
fine.
it's a good year for Mark. But honestly, he runs a utility that benefits all of us. Like
That's right.
their reciprocal deposit thing is just a magic trick, and he doesn't overcharge for it. So I'm good with it. But the bigger problem to me is that when we didn't really have any endemic rates in the economy, which we haven't since the global financial crisis, I think the bankers and credit union leaders got overconfident about the stickiness of their deposit bases. And in fact, I personally find it a little offensive, this, this overconfidence, this feeling that, oh, no, our depositors, even though they could just empirically get a better deal elsewhere, they will stay with us. And I think they may frame it as they'll stay with us out of loyalty, but what they really mean is they'll stay with us out of inertia, that it's not worth the hassle to them. But I think that underestimates a few pretty fundamental changes in the financial system in the last 10 years since we had rates that were worth chasing. One is, of course, money moves more quickly now. Two is it moves more easily because of open banking. You can use third-party apps to manage money and move it around. You don't have to go through the laborious bank systems each time you want to move money. And then finally, and this is a little future oriented, but new technology like generative AI, when it's capable of acting on behalf of customers, you can automate complex tasks that historically have been challenging to automate. So I think if you put it to a credit union CEO and said to them, okay, say, imagine all of your customers tomorrow had the superpower of doing exactly what was in their best interest, of moving their money to where it could get the highest rates, of shifting their loans to where they could pay the lowest rates, and of managing fees to zero in every case. If you ask a self-critical and candid credit union leader or banking president that, I think they'll admit that they would lose almost all their customers the next day. And so if your business is dependent on your customers making mistakes, I don't know if that's a great long-term bet.
Yeah, so I challenge some of them in that regard, and I think the answer that comes back more often than not is, look, interest rates for the last decade were held at such low rates that those deposits weren't worth much, right? And I think that in effect becomes part of the challenge, right? Is that there's a whole group of executives who lived in an environment where deposits were just cheap. Now that's no excuse, right? But at the end of the day, there's so many different sources to fund your other side of your business, which is your lending business, that you forget how to do that. And there's a whole discussion now around, wow, gravity has now sort of, left the system, right? Beta on these deposits will go up, and that should spur some innovation that we haven't seen in a very long time in the banking industry, right? And to your point, right? As you said earlier before the call, this concierge of banking I've been chasing for probably 2 decades, right? I was probably too early in my life in trying to do it. My question is, how productizable do you think generative AI is, and how far away do you think we are from that concierge that will, when I get up in the morning, refinance everything that I should have refinanced and move my money to places where it should be because it gets the best yield?
My best guess is 2 or 3 years. And um, I think the regulators are going to play a role in this. You know, we have a very powerful consumer protection regulatory apparatus in the US, which is a general matter I'm thankful for. But it can be kind of slow moving, and perhaps regulation should be slow moving. But I think there are unsolved matters here. Would this agent have power of attorney for you? Like, how would it actually work? This account opening and money movement mechanic, and how will the banks and credit unions and other depository institutions or lenders, how will they participate in that? Will they gladly face off against these autonomous agents, or will they work hard to block it because they realize that that kind of fluidity, that kind of intelligent fluidity is dangerous for their business model? I think there will be lots of fits and starts, and it won't be primarily about the technology. I think the technology problem will be solved within a year. I think the regulatory and kind of competitive dynamics amongst the incumbents will draw things out for another year or two. But it's no less inevitable for that. And I'd be shocked if it was 5 years away. And it's a continuum, like a concierge that literally does everything for you, I think is the ultimate state. But a concierge that does 95% of it for you is pretty darn good.
Mhm.
If you had to wake up in the morning and click a mouse 3 times on a DocuSign, you'd probably do that to save hundreds of dollars a year. So I think it probably doesn't make sense for bankers to sleep on this phenomena, even though it's not imminent. And actually, as you mentioned, really it should be about delighting and caring for your customers. It should be about engendering loyalty and customer love. My friends at Bain and Company have these great books about customer loyalty and
Right.
Net Promoter Scores, and newly one about customer love. And these are really important concepts. And I think the banking industry in the United States, it comes out of a dual history on one hand of state-based branching law, and in the credit union side, generally speaking, geographic employers. And so between the two of those, you have this incredibly geographically situated industry. Um, and none of that really matters anymore. Or at least that would be my challenge to the leaders of this industry, is if the whole reason you exist is because of geography, and in a digital world, we can at least agree that geography matters less. And you might even argue that it almost doesn't matter. Then, what in fact is your raison d'etre? How do you build customer loyalty and customer love? How do you maintain it in such a way that you can get paid for it by having stickier customers, both on the deposit side and on the lending side. And so whatever timetable before or that potential extinction event of autonomous concierge agents is, that's sort of less important. What's important is let's act as though it's coming tomorrow. How would you defend your business? How would you actually delight your customers so that whether they're lazy or not, they choose to stay?
So it's interesting, right? So there are some historic proxies for how banks behave. I started screen scraping back in 1999, and we know how they reacted. They questioned whether the account opening application allowed you as a customer to allow some third party to actually log in and use your credentials. And that was a battle that was fought for almost a decade, right? Until open banking finally showed up. And I think many bankers recognize that as a lesson learned, that you can't fight that, right? Fighting your customer's desire to use other apps to facilitate financial literacy or to facilitate their ability to transact with your institution is a losing game. So hopefully, right, history will teach them a little bit. And you and I are both students of history. I'd like to say that that's probably not the right response. Uh, I agree with you that it's about delighting the customer. And one of my favorite customers is Navy Federal, and Navy Federal has this wonderful sort of slogan. It's "Show me you know me," right?
Mm.
And it's all about recognizing the customer's relationship and providing some kind of customized offering to them. And that concierge is exactly the types of things they're doing. And to their credit, they signed their 13th millionth member this year. Uh, yeah, which I find very fascinating. And their response would be that they're relevant because there are banking deserts out there that again created every time, like Bank of America. We've seen what they've done. Morgan's very, very efficient in digitizing that bank. Yet JP Morgan Chase is still on a multi-year rollout of more branches. Uh, but but they believe that what they sell is trust, and part of trust is seeing that branch, especially when there's concerns about deposits. Because I remember my John Reed days at Citigroup, and John's thesis around the ATM. He said my dad was a fresh era baby. The reason why ATMs are important is we want to put the money in front of the lobby, not in the vault, so consumers have access. So there are some things I think that human nature doesn't make it so simple, right? They want that plus something else. So I think some physical presence probably makes some sense. That would probably be the argument back and also that it creates some trust along the way. But you're absolutely right. I think delighting your customer with that kind of capability to customize things makes a lot of sense. Another 3 minutes left. I want to jump into some of your investments and what you're going to do with this big treasure trove, because I think most people are very interested in your opinion about what's happening next in tech.
Well, you're kind to say that they might be interested. As I think about our strategy at the highest level, we've been pretty consistent over the last decade. We are 90+% focused on B2B within Fintech. We look for models that are quite software driven. We've written extensively about embedded finance, and that really has characterized most of what we've invested in, which are basically software companies that have an ability to monetize through embedding financial services, probably most notably payments acceptance, but also issuing payments, storing money, lending money, increasingly insurance, theoretically banking as a service, although I think that frankly has been slower to penetrate. I don't think most people want bank accounts everywhere they do business. But we're seeing it in new fields like treasury management, where you have software that can newly be entitled with the ability to store money and optimize rates. We're seeing it in supply chain finance as more and more of the global economy gets software enabled, as more and more workflows are intermediated by software. The ability to present financial services and financial products at the point of need, embedded in sticky data rich software, which knows more about the customer and the context than any banker ever could, we're still in the early innings of that evolution. So B2B companies with a software DNA at their core, we focus primarily on payments and wealth management are sort of our two core segments, with insurance being a close third. But those industries, all three have this recurring revenue nature. It's not a one and done transaction. It's generally speaking, maybe transactional, but reoccurring. It's not recurring. They tend to have high gross margins and sticky customers. So that's been what we've done. And as technology waves have come and gone, we've just looked to see how they apply to kind of our core business. And I think generative AI is a new wave of technology. It's already sort of, by the way, tipping a little bit into the chasm of despair. You're hearing a bit less about it, and people are starting to ask hard questions about, is it for real? Is it ready? Where's the actual ROI? And, Vince, you and I have lived through enough of these waves of horizontal technology to know that there's always this moment of questioning before your ultimate utility is proven out. So we'll probably see that with generative AI, but as an ingredient in a software business, I think you'll see it become pervasive. It is just an elegant way to access and present information. Um, so we sit here today, having observed the kind of lunacy of the COVID bubble, which is how it felt, certainly within fintech, and then the dramatic fall from grace that always accompanies such lunacy. It feels to me like we're somehow back in like 2016. Yeah, we've kind of like before the madness, but still a lot of opportunity and certainly a lot of founders building interesting businesses. So we remain very optimistic.
Yeah, I was interested in your comment about it can take 10 years for it to get back to the way it was in 2021. And only question I have is, does it need to get back to where it was in 2021? Those are some big rounds for unicorns that probably should have been with public companies and not private companies gaining more investment. But do you think it needs to get back to where it was in 2021?
Well, the last bubble in 2000, it took 18 years
Right.
for the industry to get back to that peak. And so that was 2018. And of course, we blew through that peak. I personally would be happy if it took another 18 years versus a decade versus surely anything sooner. I didn't experience 2021 as effective capitalism. It did seem like lunacy. I think the one counter argument is that, technology, let's take fintech as an example. Vince, you and I have both been investing and operating in fintech for over 2 decades. It used to be somewhat of a sideshow. You would have a bank, of course, you'd have an insurance company, you'd have a wealth manager, asset manager, and then of course there'd be fintech. This little thing off there with the weird guys doing that weird stuff. But now, to me, there's no such thing as fintech. Like if you're running any one of those types of institutions, and technology isn't at the very start of what you're doing, not off in some corner with some third party or some that, weird nephew of yours, running it. But instead, technology is the very center of what you're doing now. Then fintech to me becomes sort of like, we used to talk about digital media. Now that's all of media. And to me, we used to talk about fintech and now it's all of financial services. And so you're seeing that across different industries, healthcare, there's still obviously personal and in-person healthcare taking place, but so much more of it is digital. So tech has really overlapped its historical boundaries as just a segment of the economy and is now quite pervasive across all these industries. And so in that way, you could anticipate that the funding for technology would, in order to keep pace with that opportunity, would rebound more quickly. And so the actual question is the one that you addressed, which is how much of that funding should take place in the private market versus in the public market. And I fear that the public market, which relaxed its standards, if we're honest, in late 2020 through to early 2022, with this tremendous wave of IPOs, both SPAC IPOs and traditional IPOs, will be gun shy for a long time, having lost such dramatic amounts of money on all of that IPO activity. And so I think if you take as a given that tech is expanding, not contracting, and still has a lot of room to go, and you take as a given that the public markets are going to be inhospitable for early stage money losing companies for a long time, given this recent experimentation that went awry, then I think you can construct a case that it might be sooner rather than later that the private tech investing markets swell up again.
Matt, always amazing insights. Thank you so much. That's all the time we have for today. Matt, again, thanks again for joining me. I really do appreciate it. Thanks for our listeners to tuning in, and make sure you subscribe so you can join future episodes. And I'll meet you back in our next 22 minutes in lending. Thanks so much.
Glad to be here. Bye.